Hey everyone, welcome back to the channel. With the next presidential election approaching, there's a lot of speculation about how a Trump victory might impact financial markets and key industries. If Donald Trump returns to the White House, his policies could bring shifts in areas like energy, technology, banking, trade, and healthcare. In today's video, we'll go over 15 financial changes that could happen under a Trump administration, how they might impact different sectors, and what that means for your investment strategy. Let's get into it. This is Wealthvelocity. Here you create, protect, and grow your wealth fast. A quick word before we start. This video is not individual financial advice. Always do your own research. Number 1. Potential surge in oil and gas production. Trump's previous administration heavily supported fossil fuels and traditional energy. A renewed focus on American energy independence could lead to expanded oil and gas production. This means new opportunities for companies in extraction, refining, and distribution. Look out for big players like ExxonMobil, Chevron, and service providers like Schlumberger and Halliburton, which could see growth as production ramps up. However, if increased production leads to an oversupply, oil prices could fall, impacting profit margins. Investors should consider hedging against this potential volatility by watching commodity prices closely and diversifying within the energy sector. Number 2. Shift in renewable energy policies and incentives. Under Trump, subsidies and incentives for clean energy could be reduced or rolled back, affecting solar, wind, and electric vehicle (EV) industries. While existing projects may continue under the Inflation Reduction Act, future renewable energy projects could slow if federal support diminishes. Clean energy companies like Tesla, Rivian, and First Solar may experience greater stock price volatility due to shifts in consumer incentives and project financing. Renewable energy investors should stay updated on policy changes and consider how they might impact the competitiveness of green technologies relative to traditional energy. Number 3. Deregulation benefits for the banking sector. If Trump follows through on financial deregulation, we could see a loosening of restrictions on capital requirements for major banks. This could make the financial environment more conducive for lending, mergers, and other high-revenue activities in the financial sector. Banks like JP Chase, Goldman Sachs, and Citigroup could benefit from increased freedom to engage in riskier investments and complex deals. However, reduced regulations also mean potential risks for investors if banks overextend. Keep an eye on regulatory news and earnings reports for signs of increased activity in M&A and lending. Trump's stance on cryptocurrency has shifted, and he may adopt a more favorable view toward digital assets if elected, aligning with the Republican Party's general openness toward crypto. This could mean clearer regulations and potentially new pathways for crypto assets to enter the financial mainstream. Cryptocurrencies like Bitcoin and Ethereum, as well as exchanges like Coinbase, could benefit if more favorable policies encourage institutional investment. Watch for potential developments in crypto ETFs, tax structures, and regulations that make crypto more accessible for both retail and institutional investors. Trump's pro-energy stance could mean increased investments in energy infrastructure, including new pipelines, refineries, and LNG, liquefied natural gas, export terminals. This aligns with his push for energy independence and boosting America's role as a global energy supplier. Companies like Kinder Morgan Targa Resources and other infrastructure firms may see significant opportunities as demand for new energy infrastructure grows. Additionally, natural gas stocks could benefit if the administration greenlights projects aimed at expanding LNG exports to international markets. Trump's approach to trade has traditionally included tariffs and trade barriers, especially with China. If he reintroduces tariffs, tech companies reliant on international supply chains may face higher costs and disrupted logistics. Apple, Microsoft, and other major tech firms with manufacturing ties to Asia could see increased production costs, which might impact profit margins and product pricing. Investors should watch for companies exploring supply chain diversification, potentially moving production to countries like Vietnam or Mexico to avoid tariffs. In light of rising geopolitical tensions, particularly around Taiwan, a Trump administration may increase defense spending. This could result in substantial contracts for defense contractors and aerospace firms. Companies like Lockheed Martin, Northrop Grumman, and Raytheon Technologies stand to benefit from heightened demand for defense equipment and technology. Defense sector stocks may see growth as the government prioritizes military readiness and expanded capabilities, especially in aerospace and cybersecurity. With fewer regulatory constraints, banks may find more freedom to pursue mergers and acquisitions. This can lead to significant revenue boosts from advisory fees and lending, particularly for larger banks with global reach. Investment banks such as J.P. Morgan, Morgan Stanley, and Bank of America might benefit from an increase in M&A activity, which could drive earnings growth. If the banking sector sees increased consolidation, this could also mean stronger valuations for those with the resources to acquire smaller competitors. Trump's previous policies led to increased tariffs on imports, which raised costs for many consumer goods. If tariffs are reintroduced, sectors like electronics, automotive, and retail may face higher prices and inflationary pressures. US-based manufacturing companies might benefit from less foreign competition, but companies reliant on imports could see profit margins shrink. Consumer goods companies like Walmart, Amazon, and automakers may see rising costs, potentially impacting stock performance. Look for price adjustments and inventory shifts as companies adapt to new trade policies. Trump has historically pushed to reduce drug prices, and a second term could bring renewed focus on healthcare cost reforms. This could impact pharmaceutical companies, particularly those with high-cost drugs or reliance on Medicare. Big pharma companies like Pfizer, Johnson & Johnson, and Merck may face challenges if price controls are expanded. Investors should stay informed about any policy shifts that could impact drug pricing, as this may affect profitability and market positioning for pharmaceutical companies. If a Trump administration implements tax cuts or increases government spending, inflation could rise, prompting the Federal Reserve to raise interest rates. This could have wide-reaching effects on borrowing costs, mortgage rates, and consumer spending. Financial sectors like banking could see increased demand for loans, while consumer sectors reliant on credit may face challenges. Investors should watch for changes in inflation indicators and Fed policies that impact interest rates, as these will influence market volatility and consumer sentiment. Trump has previously championed American manufacturing, and a renewed focus on domestic production could benefit companies that are US-based. This aligns with the goal of reducing reliance on imported goods and encouraging local production. Industrial companies like Caterpillar, 3M, and General Electric could benefit from policies encouraging US production. Watch for potential incentives or tax breaks designed to boost American manufacturing, as this could impact industrial sector stocks and create new opportunities. Geopolitical and economic uncertainties often drive investors towards safe haven assets like gold. With potential market turbulence under a Trump administration, gold might become an attractive option for those seeking stability. Gold ETFs and companies involved in gold mining, such as Barrick Gold and Newmont, might see increased interest. Gold prices often rise during times of uncertainty, making it a potential hedge against inflation or market volatility. Trump's focus on real estate and infrastructure could lead to new opportunities in these sectors. Eased regulations and increased infrastructure spending may benefit construction and real estate companies. Look for potential growth in REITs, infrastructure stocks, and real estate investment opportunities. Companies involved in construction like Vulcan Materials and Caterpillar could see increased demand as infrastructure projects expand, creating investment opportunities within the real estate sector. A Trump administration may take a lighter regulatory approach to emerging technologies, especially artificial intelligence. Reduced oversight could enable faster advancements and greater innovation in AI, potentially benefiting the tech sector. AI-focused tech companies like NVIDIA, Microsoft, and Alphabet may experience accelerated growth with fewer regulatory constraints. Watch for advancements in AI and increased spending on tech innovation, which could impact productivity across sectors and create new investment opportunities. And there you have it, 15 financial changes to consider if Donald Trump wins the election. From potential growth in traditional energy and banking to shifts in tech and trade, a Trump presidency could bring notable changes to the market landscape. Remember, as with any investment strategy, it's essential to stay diversified, informed, and aligned with your personal financial goals. If you found this video helpful, Please like, subscribe, and share it with others looking to understand these potential changes. And if you want to know what would happen if Kamala Harris wins the presidency, check out this video next. Thanks for watching, and I'll see you in the next video with more money in your pocket.